We're going to get institutional chasing, window dressing, tax loss harvesting, holiday spending surge. You don't fight the Fed, right? It's plain and simple. Don't fight the Fed. Don't fight the Fed. It's not in your favor to fight the Fed. They're cutting interest rates. Let's go ahead and put those on there. USINT. See, this is it right here, and I'm going to turn it black. Okay, the Fed is cutting rates. Do not fight the Fed. If we're going up, then yes, I'm a little more like, okay, I'm a little more cautious. But the fact that they are in a cutting cycle, not to zero, maybe we base out around 2.5. I don't know. The fact that they're cutting, you just don't fight the Fed. Where they're going to cut tomorrow, then they're going to announce, or they're going to let us know, hey, are we cutting in, December? I think they do. I think they're going to cut twice. The labor market is weak. They might surprise us and do 50 basis points tomorrow, might shake the market a little bit. I think we're expecting 25. They might cut 50. Who knows? Either way, dude, chill out, right? I don't see a top until next year. I don't think we really see a 10% correction. That's my my big guess here is I think we get a 10% correction somewhere between February, March, April, or May. I don't know. Somewhere in that quarter, right? I know that's a lot of months, but depends on how quickly we go up, how fast we expand. If we go slowly, then maybe it's going to be, April, May, March. But if we go up quickly, it could be February. So, and we have these all, this is all measurements going back in time that I have here. So, number one, don't fight the Fed. They're ending QT also, guys. They're ending quantitative easing, right? I'm sorry, quantitative tightening. What does that mean? I don't even know if you guys want to see this, but they're ending quantitative tightening. Damn it, I don't have that up. See if I have it here. Where's my layouts at? All right, it's going to take too long because this is going to be on YouTube. They're ending quantitative tightening. All right. And what that means is they're no longer the most powerful driver in the market, is no longer removing money or liquidity from the market. They're no longer, because right now they're sucking cash or they're sucking liquidity. There's so many ways to talk about it. They're sucking money from the system. Now they're not injecting money, but they're stopping the suction. That's very bullish. It's going to create what? More positive momentum, more confidence, more deposits, more fervor, more zeal, more liquidity, more credit, more optimism. That's what it creates. So don't fight the Fed. They're cutting rates, they're ending QT. There's going to be a liquidity surge, right? It doesn't last forever, but there's going to be a liquidity surge as they end that. Number two. Okay, number two is institutional performance chasing. So a lot of institutional is called the window dressing. A lot of fund managers, right? Their careers at risk because they missed Nvidia, they missed Oklo, they missed momentum. They were like, oh, let's do value stocks. Let's dig into value. Value didn't do shit. Okay, the value trade is over, depending on how you define value. But consumers, consumer cyclicals. Watch, I'll show you right now. Matter of fact, we've been watching this. I'm gonna pull it up on this chart. If all you got to do is go to XLD, right? XLY, which is going to be consumer discretionary. Look how it's performing against. Actually, let's do XL, not V. What is it? XL. Can't even think of it. XLS, XLP staples. There we go. XLP is staples, consumer staples. These are the value trades, the dividenders, the defensive stocks versus XLY, which is our consumer discretionary cyclical stuff. Okay. Did I really mess that up? And when we go to this chart, we're looking at the relative strength of value traps, which I'm calling them, versus cyclical, high growth discretionary. Look at that chart. This is trash. The last time it really went up was 2007 to 2009, right? That was late cycle economy or business cycle. Ever since then, it's trash. Last time it went up was December 21st through December 22nd before the bear market. So eventually we're going to get a spike, but we're not there yet. And we're going to talk about that. If you stick to the content, you stick to, if you listen to me further, we're going to tell you when, or we're going to talk about when we get closer to consumer defensives outperforming and when it's time to get out of high risk cyclical, growth and, small caps. That time is coming. We're not there yet. So back to it. Institutions must perform, so they're going to start buying all the crap that's already going up. Okay, that's one factor when it comes to institutional performance chasing. Number two is tax loss harvesting, right? Or lowering their tax liability. A lot of these Fidelity, all these big, BlackRock, whoever it is, whoever their losers are, they're going to optimize by selling their losers. They keep selling their losers off because it gives them, less tax liability, and they buy them back in November. So October 31st is the last date, and then November is when they start buying back. They might be buying back late. Who knows when they buy back? Anyways, once you hit November 1st, the institutions, the mutual funds, right? These baby boomers, they're going to start pouring liquidity into the stuff like Enphase, which I want to check up on. I think they just had earnings. They're going to buy back these solar stocks that are getting destroyed, MSTR, for whatever, because there's an edge there. They're going to start buying back whoever got smashed. So you're going to get a double dip of the winners are going to win and the losers are going to win. So performance chasing, that's a, FOMO. That is your FOMO. That's a FOMO. That is another factor. Next factor, holiday spending surges. Usually, what do you have? You have Halloween, Thanksgiving, Christmas, and New Year's. How much does this impact the market? It really puts a floor, because it's like, okay, we're going to get a lot of spending. What's that going to do? Banks are going to be lending a lot more. Credit's going to go higher. It causes a FOMO effect, right? Everybody wants Black Friday. This is where people spend the most. From October through December, you could say January is the most consumer spending in the US, at least. Travel, right? Social spending. You don't want to look bad in front of your grandparents, or I'm sorry, in front of your cousins. You want to show off. Human emotion takes over and people spend more even what they don't have. So that's going to push the market higher. Okay, so it's a simple one. Number 3 is the ISM survey. This one's simple. Okay, this one is what I'm really focused on to see when the bear market comes. This is my best. I don't want to say my best. This is one of my favorite indicators. Let's take a look at it. I might have to switch. This is internals. We're not looking at internals. Oh no, I got it on here. We're gonna change this because I want to. Okay, we're gonna go to. We'll pull it up right here. Terrawolf, can't forget about that. Okay, move to macro. Okay, so we're gonna go to the ISM. This is business confidence, and yeah, we've been waiting. What did I put this on here for? I think it's gonna outperform after August. I guess I was wrong. Anyways, you're waiting for the EMAs to. No, I'm just kidding. That has nothing to do with EMAs, right? This is macro data. So this cycle right here, up and down cycle, this is the business cycle. I want to explain this clearly. This is very important. Bitcoin peaks every single time, right? If you go back to 2010, didn't exist really. It peaked here, Bitcoin peaked here, and it peaked here, right at the top. Why? Because this expansion here is businesses saying, all, supply chain managers are basically saying, oh, we're buying more, we see more demand, and we're expanding our operations, right? We're now more confident, is business confidence. We're in the manufacturing industry, heavy intensive, meaning they have to borrow, they have to finance. So this is pure financial cycle. This is pure finance expansion. Once it peaks, liquidity's gone, right? That's the peak in liquidity. So liquidity really has more room to go. The thing is, it might go up really quick or it might be slow. We don't know. The key here is over 50. We're not over 50. We're right here. Okay. We're under 50. This is the longest bear market in ISM, right? In, manufacturing or, business expansion. This is the longest bear market in business expansion in the history of the US. So when it moves up, I don't even really get bullish until it moves up. Once it breaks out, you guys have to be bullish. Bitcoin's going to go stupid. Look at Bitcoin peaked what? Here? January, I don't know when it peaked. If you go look at risk assets, a lot of them move exactly with the ISM, because basically, who's moving markets here? Banks, institutions, right? Banks are moving markets. These are the market makers who pile in, who take leverage. They see the debt in the system. They're literally doing the deposits. They have an edge. So when the ISM picks up, they're actually having to read, like saying, hey, look, these managers are expanding. So we're going to go ahead and take a risk because there's a lot of money that's going to flow. They can create so many deposits. They can create so much liquidity. They create dollars. They create money. And then the Fed is cutting rates. They create more. Fiscal liquidity or fiscal policy is doing what? Creating more expansion in energy and power generation. I'm telling you guys right now, okay, this is my assumption. I could be wrong. I think 75% chance that in this period right here, no, I'm sorry, this is the bear market. from here to the blue line, okay, we might see the strongest. It might not be S&P. I think we're getting ready to see one of the strongest, and I know we've already moved up, but one of the strongest bull market cycles, 1 to 3 months, that we've ever seen in markets. Okay. That's my assumption. We might see one of the strongest damn upsides ever from what I see. This is a recipe to be bullish. Don't be stupid. Don't be fearful. Don't listen to these fools talking about recession. They're stupid. I'm sorry. I just say they're stupid. Dude, why are you talking about recession? You're talking your books. There is no damn recession. Okay. Donald Trump is the most bullish president of all time to a fault. The dude only wants to see the market go up. He put in a damn bond trader, Treasury Besant. He put in a stock trader as the damn Treasury. These guys are so bullish markets, right? There's going to be a correction. I think we're in a bubble. It's building. There's more bubble, like Oklo, right? The nuclear energy is in a bubble. I'm a little cautious, but guess what? I'm not cautious. Yeah, the Fed's cutting. There is a bubble forming in different areas, but it's rotational. We're seeing a lot of rotation. You should really join our Discord for free so you can learn more about the markets. Unless you want to just be told what to do and not learn. Let's say, tomorrow I don't exist. Let's say I leave, I fail, whatever. You want to know how this works. I could die at any day. We all can die at any day. You don't want to be stuck trying to trust somebody telling you what to do. You want to learn how they think. All right. So I'm telling you how I think. And, if we go back in history, or we're not talking about the correction yet, we're setting up for the most explosive bull market rally, which I think starts in November. More seriously, or more, a lot of it starts with the ISM. If we get the ISM expand over 50, I think it starts. That's November 4th. So I'm going to say November 7th, we should be in a very vicious bull market by November 7th. Okay, that's my assumption. And that is rising at the moment. So the real question is, where's the correction? That helps us, gives us visibility. So look at this. We're going straight up after this crap where it's like, oh, trade war. Trump is smart now. He's going to taco. He's going to reverse. He's going to make a deal. Don't buy into that. The market will correct because of excessive exuberance, because of too much leverage, because of too much optimism. We're still not there yet. You need to understand the internals, which I've been preaching in my Discord. On here, you only get me once or twice a week, maybe 3 times, depending on my schedule. But join the Discord for free so that you, and I'm not saying, I'm not charging you. It's free right now. We're going to charge later when you see how valuable this information is, right? Maybe it's not for you. I wish somebody gave me this when I was younger. I wish when I started, I knew this crap. I would have made so much less mistakes. You have to survive if you're trading. If you're investing, you're lucky. You just buy the tech, right? But if you're trading, you have to keep learning how markets change, right? So we're in a very vicious upside cycle. I think the peak is somewhere between February. This is our window, February to May, right? Could be mid-February, early February, late February. This is our next earnings, by the way. We're in the middle of, Q3 earnings. This will be Q4 earnings, right? It's Q1, but it's looking backwards to Q4. So this is my window. Now let's go back in time. Okay, and see how many times. As a matter of fact, this was 2018. This is when I first started investing. I remember this to a T. Apple came out. My first stock ever was Apple. Well, that I got size in. I put in $800 and I was like, boom, Apple goes lower February. Seasonality is real. So anyways, from February, this is all February to May. These are all windows from February to May. Look at how the market is either down or choppy. Rarely is it up, down or choppy. That's why I put a mad face, down or choppy there. How about this? Now, this was coming out of a macro event. So this one actually was up. Great. And we had a couple pullbacks. That's normal, of course. And, but that was up. But here we go. The pandemic. Now, you can't really say that was seasonality. But, if you're going to dump what? Right after tax season. Not before, because you don't want to pay those taxes. So the dump is coming right after tax season, after earnings. We'll see. That was COVID, a little different. Here, it was up. This was a good performance, but you did have a dump right after February. Look, this was about a 3%. How much was it? 5% correction. That's a good size correction for crypto. A 5% correction in the stock market is about a 25, 30% correction for crypto, right? Just 5x that. Okay. And when the stock market declines 10% for crypto, that's about a 40%. When the stock market declines 40, 50%, which I don't think we're going to see in the next 10 years, that's a 80% correction for crypto. Anyways, enough with that. We did end higher, but you had two little corrections, two opportunities, right? 2022, you all remember this. If you're new, you should remember this. This was vicious, but you were choppy. It was early though, right? Right at the beginning of the year, we sold off, right? There was other stuff going on like inflation. So that was a little different. Here we go with the recovery. We had a sell off right at the beginning, and then we bounced in March because the Fed stepped in, which I think we're going to see soon. People are going to get fearful because a lot of credit, there's a lot of money being sloshed around. Somebody's going to make a mistake. A bank is going to fail. I almost guarantee you we're going to see bank failures at the end of this year by January. Liquidity is rising in one section of the liquidity cycle, but it's also hurting others. And so the Fed must inject liquidity. Somebody's going to fail. I don't know who it's going to be. Somebody's going to fail though. Bank failures, market rises because the Fed steps in. Okay. Here we go again. We went up. So this time we went up in February. We peaked in March. Then we rolled over. How much? What was that correction? This correction was 5.5%. Okay. Great. Corrected again in July. Okay. But I want to look at this period. This period was much bigger, but this was it's just so funny how we correct a lot in February, right? At the end of January. So that's where I think we're headed for. I think we're headed for a vicious bull market cycle. Okay. If I had to guess, I think the peak is going to be January, February, right? And you can never guess it, fully, but that's what my guess is. Let's look at the technicals. We're just starting to reaccelerate on the daily chart right here on the MACD from a big sell-off. So I think we're headed higher. RSI, as soon as it gets RSI don't matter for the index. The index is different for RSI, guys, because there's so many stocks. So it's driven by overall confidence. I'm not really too worried about RSI unless it's at an extreme, right? Like here, extreme, and then we sold off, right? Had a correction. Extreme, a little bit, sold off. Anyways, let's go to the weekly. What does the weekly look like? Okay. This is a little more scary. This is where I think we get a correction. And we talked about this last stream. RSI is at the end. Okay. RSI is at the end. Matter of fact, let me throw this up here. It looks better. RSI is already peaking, meaning we still can go higher now, but in 3 or 4 months, we aren't going to have the same power, right? The power, the rotation of the when your stocks go up 50%, you're not like, oh, let me throw in more money. You're going to take profits. So I think we're going to near take profit later. Okay. RSI, we're still expanding in the, for our MACD, but look, it's at the end. This looks a lot like it did in February 2024, where we started to chop around. Okay. We started to chop around here. We had a correction. We went higher, which I think we go higher 2026, but we're going to have a correction of 5 to 10%, or we might chop for 2 or 3 months. Who knows? Right. Versus here, okay, this is too much now. Or let's just say this, we were very early this time, right? Back in 2022, we were early. 2023, we're early. The RSI was just picking up, crossing midpoint here. That was a very strong market. MACD crossing up, barely crossing up, very strong market. This time, MACD's at the top, RSI at the top for these next 2 years. So I think we have a vicious rally into February, saying it again, and then we sell off, we correct, we find our ground, we find the next narrative, probably going to be AI, blockchain, who knows, power generation, robotics, right? And then we'll figure that out. But for now, that is what I want to communicate. Okay. ISM is what we're watching. So don't fight the Fed. We're going to get institutional chasing, window dressing, tax loss harvesting, holiday spending surge, whether you like it or not. It's just confidence. It's more inject. It's like being drunk. You're drunk. And then business confidence, right? That's the last boot to fall there. That's my take for the rally. That is my take for the rally.